Here's a simple trading strategy that you can use. Now, this isn't for anything that's like a short, like a day trading or anything long term. This is a short term trading strategy that I've been using for a while, and it's worked for me consistently. And it's using adjusted cost basis for your stock. So what you're gonna do is, a week prior to a company's earnings report, you're gonna buy that company's stock. Now, again, you want to look at the other things. You want to do your research. You're gonna look at the PE ratio, the analyst recommendations, revenue, and the prior EPS trends, right? You want to look at all that. But the main important thing is finding a company that's predicted to beat earnings, right? People need to have a positive, bullish sentiment on it. You're gonna buy with majority of your buying power. So what do I mean by that? Let's say my buying power is $30,000. Well, I'm gonna buy $18,000 worth of that company's stock that I think is gonna go higher after the EPS earnings call, right? Now, a lot of times what happens is the opposite. Companies report bad earnings, or the guidance is bad, or if the investors are just not as fulfilled with the earnings, they start selling, the stock starts dropping, maybe 6 to 7% in the reverse trend that you had expected. Well, what you're going to do in that case is you're going to take the remaining 12,000, well, in my case, 12,000, you're going to take the remaining of your buying power and you're going to invest it into the same company once the stock drops. What does this do? Now your new cost basis has changed and it's somewhere in the middle. So even when it drops, and then the investors, eventually realize that, we may have overreacted, or the company finally reports, better, or some kind of partnership, some kind of news in the market, the stock's going to start climbing upwards, and then you'll be profitable in about 3 weeks till about a month or so, right? Or again, on the best case scenario, the earnings are good, and then you take, your profits from that 7% increase or whatever it may be. I did this with Meta, and it worked great for me. I did this with Microsoft, didn't work so good, but then I adjusted my cost bases. Now they're going back up, so I already sold out of it, and I was still profitable. You can keep doing this over and over, but again, you want to make sure these are large market cap companies. These are companies that, if your short-term sentiment, if you're bullish short-term and you're wrong on it, is the long-term still good in case you do end up having to hold. Now, this isn't by far a genius investing strategy. This is something if you're looking to do on the side for short-term gain purposes.